All right, we're live here, and my name is Amar, and this is Kyle.
Hello.
And today we're going to talk about capital gains and kind of some of the nuances around that. But before we get started, obviously Kyle and I have disclosures that we want to share. So basically, we haven't taken your accounts or anything about your situation or any relationship has not been formed. This is strictly educational purposes. What else do we have to say, Kyle? There's no client agreement or client relation. We're not entering into a client relationship.
Yep. So I'm not your CPA, and Amar's not your financial advisor, or there's a chance that's not the case if you're viewing this video. And this is just a discussion between Amar and myself. And nothing is official advice. If you guys ever want any, want to contact us, our contact info is below, and we'd be happy to talk with you. But yeah, for today's purposes, this is just a discussion between Amar and myself.
Strictly educational, right? It's the world we live in. But anyway, so
Gotta say it.
Yeah. So let's start with what is capital gains. Why don't we start with that from your perspective?
Sure. So there's a couple different classes of assets that you can have that the IRS classifies. It can be a business asset or a personal asset or what's called a capital asset. The lines get blurred there quite a bit, so it really depends. But anything that you are holding for investment purposes, whether it's a security or a piece of real estate or anything that you're holding, like I said, for investment purposes, that's going to be considered a capital asset. And so, as you know, a lot of equities have appreciated greatly over the last couple of years. A lot of real estate has appreciated greatly over the last couple of years. And so a lot of our clients are put in a situation where they have capital gains or accrued capital gains. And capital gains, like I said, it's just the appreciation from when you purchased it to when you sell it. And there's a couple of different nuances there on how it's taxed. But generally speaking, it's better to have capital gains than what would be considered ordinary income. And ordinary income would be wages and salary and things that you'd get from your employer. But yeah, there's short-term, long-term capital gains. They're taxed at different rates, and how it interacts with your other income on your tax return is going to also affect how your tax on capital gains. So
I'm going to just stop you there because we're going to probably want to do like a deeper dive into those type of scenarios. But so just basically you have like a cost basis, and that's when you bought your security, right? And then when your stock or real estate, whatever it is, goes up in value, and that's the new fair market value. When you sell it at that dollar amount subtracted from what you paid for it originally, that part is the gain. And if you sell it for less than what you bought it for, that's a loss, right? And so if you think about it, you can have short-term capital gains and long-term. The difference is that short-term is less than a year, and it's taxed as ordinary income, like Kyle mentioned. Now, I know a lot of people are going to say, well, isn't like the current president trying to change some of those numbers and stuff? And short answer is yes, but does it apply to you? I don't know. Kyle, you probably say the same, right? We don't know yet because nothing's in stone.
So I can unpack that a little bit. Let's start with short-term and long-term, right? And so the IRS determines short-term as less than 12 months. So if you buy a security in May and then sell it in July, you've had a 90-day or 180-day holding period somewhere in there, and that would be a short-term capital gain. So if you bought Amazon at $3,000 and now you sold it at $3,700, you have a $700 per share capital gain. And so you'd be taxed at your ordinary income rates, which are going to be typically higher, and it's less. You don't really get a tax benefit for holding something for 2 months. Conversely, if you hold something for 12 months, you get what's called long-term capital gains. And long-term capital gains have had a preferential tax treatment since like 1915. And so, it's been a long established principle that long-term investments are good for the economy. They want to, the IRS wants to incentivize people to hold things longer term, have more of their capital at risk, and you get to pay what's called, the long-term capital gains rates, which top out at 20% with the current laws. Now, 20% might be changing here soon. As you mentioned, the current administration wanted to, they proposed anybody over $1 million in income would be paying around a 40% tax rate on long-term capital gains tax. And so this would be, a huge effect on a lot of our clients' portfolios. If you're in that higher income bracket, I'll pretty much double your tax burden per the current proposal.
Yeah, and you got to add in the Social Security component too, right? So there's another 3.8% there, right?
Yeah, and so that's the net investment income tax, which was another supplemental tax for the Obamacare taxes. I think that started in about 2013. And so then you also have that to factor into your.
And then if you live in California, you have state income tax on top of that. So realistically, if you have a lot of income, then your long-term capital gains and your short-term capital gains is almost the same rate, or will be the same rate.
Essentially, yeah. So anybody over that $1 million threshold would get hit with that for the current proposal. But that's exactly what it is right now, is a proposal. So nothing's in effect right now. I think general consensus is that that's probably not going to happen. I don't think they have the legislative majorities to push exactly what they proposed through. So what I've been telling clients is I would expect, a 28 to 32% capital gains rate for long term would probably be a little bit more realistic, but they are not going to go down. That's 100% guarantee. So
yeah.
Right now, you're probably have the most advantaged tax treatment for long-term capital gains. The sooner you sell it, probably the better. If you're deciding between selling now and December, I've generally been recommending clients, the sooner the better, because there could be a kind of a grandfathered element into the new laws if it were passed later this year.
No.
How long that grandfather treatment is, we don't know. It could be 30 days, could be 60 days, could be all of 2021. It just depends, and so it's hard for me to recommend any action on it right now. I wouldn't recommend selling the whole portfolio because of a capital gains hike scare, but definitely something to factor into your decision making.
Yeah, and I think that again, you said it's a proposal, right? Like we don't know what's if you read newspapers or the rumor mill or whatever, they're also talking about this $400,000 number has been pushed around a lot, and maybe tying it to that. So there's so many variables. Don't sweat it. But most people that are probably in the camp of having capital gains may not be in that $1 million+ income threshold, and so there's something to consider, is that there's a netting effect when you do your capital gains. You want to talk a little bit about that first, Kyle?
Sure. Yeah. And so the way capital gains works is that your short-term capital gains net with your short-term capital losses, and then you kind of put that number aside, and that's one bucket, right? And then you have your long-term capital gains and your long-term capital losses, and those net into another bucket, so bucket number 2. So now you compare bucket number 1 and bucket number 2, and you net those two together, and that's your net overall capital gains for the tax year. So generally you want to, if you have any short-term capital gains, you can use long-term capital losses against them if they net in that manner. So generally you want to be using short-term capital losses against short-term capital gains if that's applicable. And you want to be netting long-term capital losses against either short-term capital gains or long-term capital gains.
Yeah, and let's maybe put some real numbers there, so it kind of hits home more. Is that if you have a short-term capital gain that would be taxed at like 32%, for example, and you have a long-term capital loss that's taxed at 15%, for example, you're trading in something worth 15 cents with 32 cents theoretically, from a tax treatment perspective. That's the most optimal. And that's the most optimal. Sometimes it doesn't always happen like that, but if you can, long-term losses versus offsetting short-term gains is probably the best scenario.
Yeah, and so in today's market, it's hard to find long-term capital losses, I think. And if you're trading kind of more on a more frequent basis, it might be easier to actually find short-term capital losses.
Yeah.
Ideally, you want to be offsetting all of your short-term capital gains in a perfect world. Doesn't always factor out like that, and I would say don't let the tax tail wag the dog on a lot of your investments in that sense. But if you have a method to control that, if you're looking at December and trying to mitigate your capital gains at the end of the year, you might find yourself in a position to kind of play with the numbers a little bit and get the best tax treatment for yourself.
Yeah, exactly. And I often find that, looking at these numbers throughout the year, not just at the end of the year, because every professional is looking at the end of the year, right? To see these numbers. So from an investment standpoint, sprinkled throughout the year, if you see volatility, that may be an opportunity to say, hey, how can I, reposition or, take some taxes off the table? And I think that would be good. But so I think, let me just summarize, if I will, Kyle, like the three big concepts that we went over, right? Like there is two types of capital gains, right? There's short-term and long-term. They have different rates. I know there's a lot of talk about that stuff, the percentages for those two rates to be changing in the future, but it's just a proposal. We don't know what the actual numbers are, so don't worry about it until it's actually out there. And then the last thing is that there's a netting effect of capital gains, versus your short-term gains versus your short-term losses. So you get a net number there, and then you get a net number on the long-term side, and then you can net those two together. But oftentimes, if you're trying to optimize, you're going to want to take a long-term loss to net a short-term capital gain. Anything else to add?
No, I think that's great. And I think that summarizes it pretty well. And it's all stuff to monitor in your portfolio. And so the sooner you address it and the more you monitor it, the more options you have. Because if you're looking at December 30th, your back is against the wall and you don't have the options that you would have during the year to optimize your capital gains.
Yeah, and if you're using like mutual funds or something like that, like an SMA, I mean, you don't have actually control of the capital gains are within that fund either. So you may be controlling one part, but then you can get something else that spits out from the underlying investment that could throw you for a loop.
Yeah, no, it depends on which mutual fund you're in, but generally in this type of market environment of increasing price in equities, you're likely to have capital gains at the end of the year from a mutual fund. It's hard to predict those amounts and makes planning a little bit more difficult, but you can almost guarantee that you're going to have some capital gain distributions from mutual funds. So
cool. Well, thank you, Kyle.
All right, Amar. Thanks again, and till next time.
Till next time.
Thanks, everybody.